I think that the markets, not just the bond market, but throughout all of the financial markets, they're all sort of starting to respond to overheat or inflation fears to some degree. If you look at the stock market leadership this year and really throughout much of December, it's led by all the inflation sectors for the most part. Industrials, materials, energy stocks are leading the way. Then you got the dollar is breaking down. That's an inflationary force in the currency markets. You got most commodity markets rising. Crude oil's broke to a 3-year high, and the overall commodity prices are right on the cusp of doing that. And then you got the bond market, and you're very close to that, breaking that 262 3-year high yield on the 10-year, and it's being led by a rise in inflation expectations that are embedded in the 10-year tip, which broke above 2% there last week, and they're within an eyelash of rising to about a 3.25-year high. So the financial markets are starting to react to overheat pressures, and if they do, and if they break north, I think foreign yields will also rise with the United States. So if our 10-year goes to 3%, I think German bond yields will come up a like amount. So I don't know if they'll be as big an anchor as we think if the data is there to support overheat conditions.
I mean, we're seeing the rises in yields for the German 10-year bund as well as JGB. So, Tom, I'm just curious, Jim had mentioned all the inflationary sectors sort of reviving over the past month or two. That, and then you throw on top of that the impact of corporate tax and the Fed's path to rising rates. 3 hikes at least this year is what has been telegraphed. Are the markets underestimating inflation at this point, Tom?
I don't know if they're underestimating it. I think everybody's been looking for it. Yields are low. They are rising. They should be higher. They're nowhere near where they ought to be given the economic environment, given the global central bank pressure on keeping rates low. And I agree with Jim that, and maybe a little bit differently, that U.S. rates really aren't going to be able to rise very far unless foreign rates rise as well. So if you do have, along with synchronized global growth, synchronized rise in yields, there will at some point, there will be a point at a certain juncture where the stock market starts to get a bit spooked. I don't think we're at that point yet, and I'm not sure that breaking through the 10-year yield of 262 or 263
is it concerning, though, Tom, that even with this modest rise in rates to just March highs, that the markets seem to be stuttering? The reaction is very interesting.
Maybe this morning.
Yesterday,
Melissa,
too?
It's been a pretty nice move in the market so far this year and through December. And yes, we're at that peak in yields, yet the market's at a brand new high. So I'm not sure we're there yet.
Jim, you say that you want to debond your stock portfolio. It sounds like you think rates are headed maybe much higher.
Well, I don't know much higher. I think we're going to see a 10-year, 3 to 3.5% this year. I do think we're going to. Last year, over the last 12 to 18 months, the Federal Reserve has renormalized short-term interest rates. And, you look at the moves we've had from 5 years, 2 years, and cash, it's been big moves in the last 12 to 18 months. We've had really no move in the 10-year over that period. I think this year, the bond vigilante is going to catch up with the Fed and start to normalize longer-term yields a little bit. And, to Tom's point, I'm not sure where that will break the overall momentum in the stock market, but I do think it's already broken leadership. And I don't think you want to be sitting in consumer staples and utilities and telecom if we have a rate reset on the 10-year yield. Yeah, because I think they're going to take a hit, absolute and relative. I'd rather be sitting in the capital goods sectors that tend to do better with rising yields and rising inflation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.